Good afternoon. Welcome to the TheoTrade afternoon video. I'm Blake Young. Today is July 11th, 2024, and we're going to talk about the wide shift from wants to needs as tech scares traders into safety. It is not just tech, but it's this rotation. We saw a key rotation from growth and expansion and tech stocks into safety. Now, part of that was triggered by CPI, and we do want to talk a little bit about CPI today, but we want to look at this in conjunction with just this rotation. A significant rotation. So what I have here on the chart is we have the Russell versus the NASDAQ. And going back to Monday, Tuesday, Wednesday, you can see obviously the magnitudes are a little bit different. But overall, if I adjust the size of these and move them around, what you're going to see is the NASDAQ and the Russell rallied together, they chopped together, they fell together, they chopped together, they rallied together. And if we line up any key peak of the day, generally one leads the other. And here the Russell climbed first, and then the NASDAQ climbed. The Russell fell first, and the NASDAQ fell about a few minutes later. Over here, the NASDAQ rallied, and then the Russell rallied, and then back down and back down. And part of the reason why I want to look at the Russell versus the NASDAQ is because it is that interest rate sensitive view. The Russell and the NASDAQ are highly leveraged companies, generally speaking. The Russell's small cap, they have to borrow a lot of money. And if they're going to be borrowing a lot of money, higher interest rates are going to hurt them. And today with the CPI, the hope, the expectations, the behavior from the market is thinking that, hey, therefore, we can start looking for rate cuts. And if we're looking for rate cuts, then we'd be looking for this move that would benefit the Russell and benefit the NASDAQ. That's what we thought. That's what we would have expected. And certainly we've seen that going on over and over day after day. But as we went into today's trading, look at the disparity here. Look at that difference as we saw the Russell go from 20,065 to 2146, which is a big move for the Russell to climb up that far. And if we compare that to the NASDAQ at the same point, the same juncture, we can see I can't even fit it in the screen for the size of move the NASDAQ had. This is the largest rotation or separation, delineation, divergence, decoupling of these two major indexes. And even Corey was talking about this earlier today, that he could not think of a time that we've seen that large of a difference. So the Russell climbed up, and we saw a major climb in the Russell, about 3.5%. While the NASDAQ has sold off about 3% as well. 6.5% differentiation in a single day on two major indexes. Now, the NASDAQ falling down means that tech stocks, the big seven that have propped up the market, are liquidating. And so when we look at the big stocks, the main ones that we're going to focus on certainly are going to be NVIDIA, Microsoft, Apple, the Alphabets, Google, Meta, and Amazon, but we need to throw in Tesla in there as well, because Tesla is what drove tech stocks and consumer discretionary higher. If I make the same comparison to the technology sector, the consumer discretionary sector, XLY, which is a large component of Amazon and Tesla in that sector, and compare that to the NASDAQ, you can see the NASDAQ in purple led right at CPI the fall. And shortly after the market opened, about a half hour after, consumer discretionary fell, and then they got into line. They're actually mirroring each other, tracking higher, lower, higher, lower. And so this correlation between Tesla adding into this mix is following the NASDAQ. So we know that Tesla is down quite a bit today, as well as NVIDIA. Tesla is down nearly 8%, but remember, Tesla also had a 10% up day. So this is not destroying Tesla by any stretch of the imagination, but is absolutely a liquidation of the tech stocks and of Tesla and Amazon. Applying the same two-day view from utilities to tech, you can see that flight away from tech and the rally into utilities. So utility stocks, which are normally a defensive sector and don't generally have monstrous days, they are just melting higher, pushing higher, and you can see up about 1.76%, while those tech stocks, XLK, that sector, have sold off, and again, quite dramatically. And the difference here to the difference here is ginormous. And so this is more than just a daily adjustment. Seeing a 3% move up and a 3% move down on indexes and a 2% move up in sectors and a 2.5%, 3% move down in a different sector, those differentiations between the two are a market shift. It's not just a slight adjustment. This shift looks like it has legs and the ability to continue to move over time. And even though I'm not going to talk about real estate stocks today, I do want to highlight the real estate sector was the top performing single sector from the market open today. And that's being driven again by those interest rates. We saw the interest rates slip a little bit. We saw the idea that we're breaking through key support levels on the interest rates and the bond prices went higher. And we did have a decent 30-year bond auction. That would indicate higher prices in the bonds and lower yields. And that would bolster the smaller cap stocks and real estate. But we're not going to talk about real estate because I think that is a temporary move. I don't think that it has the staying power, at least not based off the size of move we saw in bonds today. Instead, we're going to go back and discuss utilities further. We're going to look for bullish positions in defensive sectors, and first off with utilities. We talked about utilities a couple of weeks ago with the idea that we were creating a bull flag. As long as we didn't close below that 50% level, this would arguably be a bull flag. If it did get through the 50% level, our minimum target was a return to 72.90 or 73. We talked about that about 2 weeks ago. And as we're looking at this move, this breakout here, it's happened. We saw the breakout, we saw the continuation, we saw that all happen the last 3 days, and today is just the follow through. We still have the ability to run another 5% higher in utilities while also looking for an opportunity to collect premium on the dividends that they pay out. And XLU pays about a 3% dividend. But looking at my favorite dividend stocks, you know that in the past we've talked about this before, and I'm definitely a fan of NextEra. Let's put an NEE. Any of the electricity utilities are something worth looking at. And NextEra bounced off horizontal support, broke through the resistance, cleared the highs, and appears to be closing higher than the highs, which minimally would have me looking for the move from about $69.50 up to $74, and we're going to be looking for about a $4.50 move higher, which would take us up to $79. Almost exactly the highs, just like what we're seeing in utilities. NVIDIA, NextEra pays a 2.75% yield. Because it is a 2.75% yield, it might be worth just buying the stock. The dividends are nice. It's not a huge amount, but it would certainly give that extra little premium. If we're looking at it and saying, no, I don't want to do it for the stock, I just want to do it for the directional movement, keep in mind your current implied volatility is about 45%. You could do it either as an in-out type spread or a long call vertical. And we're just on the edge as far as getting paid enough for put premium on something like NEE. And another reason why I'm looking at NEE or NextEra is because I think Dominion's probably had too large of a day to chase into this one, but I do think you still have room in NEE, and we still have room to go from 51.50 up to 54, roughly a 5% move, but maybe wait for a pullback into the 51 area on Dominion. If we look at something like Duke and Southern, you're going to see they've even done more so, and we've retested the highs. At this point, I would wait for a pullback in Duke. We already had the breakout all the way back here, but now it's gone the full first target. And at this point, I would need a close above this high. Even though we put in a new 52-week high, I'd like a close above that high before I stepped into something like Duke. If we look at Southern, Southern is also rallied, and there's not as much room to go from here to the highs. So again, either wait for the pullback or a retest of a breakout of Southern through the highs. Otherwise, XLU, NEE are the main ones I'm looking for right now. XLP has not broken out, so I'm not going to spend much time on consumer staples, but I'm going to look at healthcare. Healthcare has had a really aggressive bounce off of these lows. We're now toying with the idea of breaking through this recent high, creating a price pattern, ascending triangle, and an ascending triangle would give you about a $6 to $7 move above these highs. Certainly something we could wait till we break through the 52-week high, but today could be the price pattern breakout. And if we're looking at a $6 move on a $147 stock, if we're looking for this to be a price pattern breakout through the highs and we're looking for that $6 move, there's plenty of room in there. And if we are breaking through, we're talking about another 5% move higher on this breakout, which could become a longer term trend. And keep in mind as well that when you're looking at stocks that are in the healthcare sector, they do have dividends as well, generally. And we're at about 1.55% on healthcare. If we're really seeing a flight to safety, the dividend payers are going to be an area that people are going to push money into. And some of the best movers in this broad sector would be in the subsector of the industries of life sciences tools. So like Danaher and Thermo Fisher. So let me go into TMO really quickly. And the reason why I like these a little better is not only because I had a great day, but they're bouncing off the 52-week lows. They're testing a low. They are discounted already. So if this is the rally on Thermo Fisher, and we could see this go from the low to the high, now we're talking about a 10% move instead of just 5. Danaher is going to be similar. We're going to be looking at this and saying, yeah, this was a deep pullback. We bounced here. We confirmed the breakout, and we could be going from 250 to 270. And again, more than 10% move up in Danaher. And one other clue that I'm looking at, not only the rotation from tech stocks into defensive sectors, I'm still watching gold's rally and copper's sell-off. So gold, as you can see, is broke through, had a very large day, one of the largest bullish days we've had going all the way back into March. And as we're looking at gold's breakout, that is still showing us that we're hedging against inflation, despite the fact that we showed a negative 0.1% decline month over month, and seems to be that inflation is getting in check. But we're not hedging that way. We're hedging as though inflation is remaining high. And if we look at copper, we're not seeing the demand. Copper is selling off 2% while gold is going up. And as we're looking at gold up nearly 2% and copper down 2%, this is the same divergent behavior. It's the same flight to safety. It's the same avoiding risk, not expecting growth. And we're seeing it in gold and in copper. Now, to look at some of the individual stocks there, that would be looking for something like a buy opportunity in Newmont. And we've talked about Newmont breaking through the 52-week highs, which it did yesterday, and is continuing to move higher. The price pattern on Newmont would be going from 40 to 44, so we're looking for a 10% move, and we're already 75% of the way there. We talked about that last week. Looking at Southern Copper, we rolled over. It's a bearish candle. We are creating a Gartley pattern, arguably, and we're looking for it to pull back. But what I love about Southern and Newmont and even Thermo Fisher is all of these are setting up for the squeeze type play that I've been looking at and I'll be addressing at the conference. And so looking at these moves, they've created that pattern that we've squeezed down, built up the pressure, followed by a very clear breakout, pushing through those key levels highs and are giving us key targets. Now, Southern is not quite there. It did give the squeeze, but if we get through these lows about 112, then that could be not only a return back to 105, and see an 8 to 10% drop in Southern. But that could be the continuation to the downtrend to possibly even see us drop all the way into the 90s. And that coil up that has happened in many of these sectors. They weren't just reversals. They weren't sharp reversals. They were coil up, build up the pressure, and then break out. And that's what we're going to be looking at in Southern, Newmont, Thermo Fisher, Danaher, and NextEra. That's going to do it for me today. Just a reminder, if you haven't got your tickets, get your tickets soon. Go to TheoTrade.com/24. Join us in Scottsdale, and I'll show you more of these coil up and breakouts. Don't forget to scroll down to the bottom, and you'll find the ability to buy your event ticket, book your room, get that set up, and see you in Scottsdale. Thanks, everybody. We'll talk to you again next week.